In this video, I'm going to talk about what is really driving this market. And it's probably nothing you've ever heard of. Over the last 20 some years, I have watched new products, new services come out in the financial industry. And one of the biggest ones that have been basically the guilty of creating a whole lot of havoc are derivatives. We saw the CDOs, collateralized debt obligations, blow up the financial or housing industry. We saw the financial crisis basically putting a lot of people out of business, putting a lot of people into bankruptcy out of a synthetic product. Then over time, we have now started to see new derivative products, in particular options, become the prime source of income for a lot of these brokerage firms. Interactive Brokers is one of those who said because of option trading, their business is doing great. So the question is, what other option type contracts are we totally unaware of? Well, one of those that has come to light in the last, I would say 60 days, are what is called 0 days to expiration options. What are these, you may ask? Well, what it is it's an option contract that expires the same day it starts trading. So let's say you want to buy calls on the SPY S&P 500 ETF, and you want to get it super leveraged real quick and not obligate a lot of money to it, and you're willing to have it be brief. Well, a 0 days to expiration option contract, you could buy it in the morning, and by the end of the day, it expires. It's worthless, unless you've traded it and made money. Well, over the last couple weeks, we have seen a massive influx into these 0 days to expiration options. A week ago, with January 9th, was the week where the market did great. S&P went up, Dow, NASDAQ. But the S&P, in particular SPY, did really great. Yet there was really no economic news that would support it. Rather, it was 0 days to expiration option contracts that drove it. The institutions, the hedge funds, have all just jumped on this bandwagon in a big way. And they are pushing these ETFs way higher, along with Tesla. Tesla had a good week 2 weeks ago because of these contracts. Not because they slashed their prices on their cars, but rather because the institutions are leveraging and trying to do better, way better than they did last year. In particular, the hedge fund industry, who got beaten up last year, underperformed their benchmarks. And so this is one other way that these guys can get exponential returns and not allocate a whole lot of money. Whereas if you bought the SPY, you'd spend a couple $100 on it right now. Or if you bought the options on it, say a week out or a month out, or you bought leaps, which are more than 9 months in duration. But now you can buy these 0 days to expiration options, and you just trade them all day long. The thing about it, options, is they decay as they get closer to their expiration. So you can imagine with a 0 days to option expiration option, your theta, which is your decay level, escalates after 12 o'clock Central or after lunchtime. And as you come into the end of the day, those options decay, or the value decays really, really fast. Well, if you got like billions of dollars pounding into these options, they falsely move markets, creating really a unstable market and a false sense of hope that we're not entering a recession, or in a recession, as I believe, and instead retail investors start jumping back in, and then the market will eventually tank. Which brings us to Thursday of this past week. Netflix, after market close, came out and reported earnings. They killed it on this new subscriber level. They were up 3 million over what the street was projecting. But on their earnings per share, they reported 12 cents per share versus 45 cents what the street was expecting. If you look at it, the fundamentals of that company are really being questioned, but it's the subscriber thing that came into it. That then opened up the NASDAQ, which it represents about 1.28% of the overall assets allocated in the, say, triple Qs or the NASDAQ 100. This isn't a big influencer compared to, say, Microsoft at 11.92%. But because of that, we saw an influx of a lot of these 0 days to expiration options get initiated, bought, and then pushing the market up higher, both the S&P and the NASDAQ and the Dow. And I think the NASDAQ was up over 2%. Yet, really, there wasn't any good fundamental economic news that would warrant such a move. Yet it's falsely being pushed by these derivative products, in particular, the 0 days to expiration options. So as an investor, we have to filter out the noise, the manipulation versus the true facts. And today, my belief is we're still headed downward. My question is when they flip from buying calls on the indexes or on the individual stocks with these 0 days to expiration options, and they go short and they start buying puts, how fast will this market fall? How fast will companies like Tesla or Apple or SPY, the S&P 500 index, crater? And my belief is mind-boggling speed. And that's why you as an investor need to truly risk manage a market like this. Be careful out there. Think about what you don't know, right? It's that whole saying, it isn't what you know that'll hurt you. It's what you don't know that you don't know that's gonna hurt you. The derivatives market is big. Friday's close represented $1.3 trillion in option contracts that expired. What will come Monday?